Hey everyone, and welcome to the RealNex webinar for CRE Market Updates with Dr. Jeffrey Fisher. My name is Matthew Smith of RealNex. We're going to be starting here in just 1 minute. First thing we're going to be going through is a little bit of house cleaning. However, I'm going to wait as the attendees keep filling in more and more and more. I want to make sure that everybody gets in before we go over the house cleaning. So we'll get to that in just a few seconds here, or maybe another minute. And we'll get things started. So we really appreciate everybody coming on today. Really excited to see what the market update is going to be about. We're going to be talking about occupancy at record highs, cap rates at the lowest of the century, and then where do we go from here, as well as recapping some things from the last meeting. Throughout this meeting, you're going to have the ability to ask us questions. Just throw them in there, and I'll be able to answer them, and then coordinate with Jeff as well to answer those for you. We're also going to be launching some polls. Please interact with us on those polls so we can get everybody's information out there and share that. Again, we'll be getting started here in just 1 minute. Thank you all for coming on. All right, it looks like it is time to get started. I want to let everybody know you are in listen-only mode. Doesn't mean we don't want to hear about you. Just can't have everybody talk all at one time. So if you need to ask a question, there's a question box in your bottom or right-hand corner, left-hand corner or right-hand corner. We're also going to be populating a couple polls. Feel free to interact with us on those polls. Love to get your feedback, as well as any chats or questions you have. You don't have to wait till the end of the meeting. We're going to be going through the RealNex webinar, CRE Market Updates with Dr. Jeffrey Fisher. And to tell you a little bit more about what we're going to be talking about, as well as the host, RealNex. We are the only CRE tech that you need. One place, one price, one login solution for commercial real estate, from brokerage firms to leasing agents, owners, asset managers, tenant reps, and investment brokers. You can visit us at realnex.com, and also make sure you check out the RealNex Marketplace. And then you'll be able to see some of the cap rates and vacancies and everything we're talking about in this presentation right through the RealNex Marketplace. This presentation will be recorded. So we'll make sure we send something out to everybody that is in attendance today. And again, if you have any questions, please ask them. We are one powerful, amazing, simple solution that you can access from anywhere, anytime, any place. Again, take a look at our marketplace that's out there. And I'd like to welcome your host, Dr. Jeffrey Fisher, CRE Market Update. And I'm going to pass the baton to you, Jeff. Jeff, are you ready?
I'm ready.
Fantastic. I am going to send this over to you. And everyone, if you'd make sure that you can see the screen, Jeff is going to go ahead and share his screen with us just here in 1 second. All right, okay. There we go.
I'm just going to switch here. There we go. Okay.
Fantastic. It's all you, Jeff.
Okay. All right. So CRE Market Update. Imagine that many of you have been on previous updates, so I want to kind of focus on what's changed from the last quarter. But for anybody that might be new, I'm really drawing a lot from data from an organization called NCREIF, the National Council of Real Estate Investment Fiduciaries, which has over 10,000 properties, over $500 billion of market value. I'll be focusing on data on office, retail, industrial, and apartment. Although they do collect data on some of these other property types. The data contributing members are your large institutional investors, your JP Morgans and Morgan Stanleys, and collecting data also from large pension funds like CalPERS and CalSTRS. One of the nice things about this data is because these properties are in funds, they're valued every quarter, so we have appraised values every quarter. And some sold properties, but relying on those appraised values, we can calculate a return each quarter and really know what's happening from quarter to quarter. So based on that data, here's an overview of the quarter. The return, which kind of surprised us, was actually up for the quarter after being down for several quarters. Before we get too excited, we need to dig into that a little bit, but the headline return for all these properties was up for the quarter. No surprise, industrial, which think of that as warehouse, still the leader of the pack. That return was slightly down from last quarter, but still way above all the other returns. The turnaround, it turns out, is mainly due to retail properties, and we need to dig into that a little bit more. which I will, but retail for the overall index was up this quarter. But there are some differences in opinion on the direction of retail properties. Cap rates, I just can't believe they went down again. Every quarter seems I say they can't get down anymore, and somehow they do. So they're at an all-time low for the entire history of this index, over 40 years of data, and occupancy just slightly down from last quarter, but still up there at that record high level. We like to kind of compare real estate returns with other asset classes. For the current quarter, the first quarter of 2019, of course, real estate returns are lower than what they've been if you look at it over 1 year or 10-year basis. Stock market, it's all over the place, right? As we saw yesterday and today, as a reminder. But for the first quarter, the stock market was up after a disaster the fourth quarter, and I think that pulled REITs up. So NAREIT, your second to the right there, index, which is publicly traded REITs, that certainly had a good quarter, but I think a lot of that is just it went along with the stock market. I went back and looked at last quarter, and REITs were down last quarter, whereas what we're talking about with the NCREIF data is private equity investing directly in the properties, or funds that are investing directly in the properties, and those returns they're down, but they're steady and still positive. And we'll see what you all think on some of the surveys, but nobody I've talked to or surveying the NCREIF members think that there's anything that's really going to cause a drastic drop in returns. We just may kind of stay at this lower level for a while. So we're always interested in what you all are thinking is going to happen in terms of, in this case, the best performing asset class for 2019. Is it going to be NCREIF, and think of that as real estate returns, private equity real estate returns? Farmland and timberland just hasn't done very well lately, but you can vote for it. Could be stocks. Who knows? It was, of course, way down yesterday on the trade wars, and but back rebound a little bit today, and who knows what it'll do for the year. But could be stocks, bonds, maybe, and NAREIT REITs. And I think Matt sees the results of those.
Yeah, we have just about 34% voted, so everybody, we're going to close the voting out here in about 45 more seconds. If you can get your votes in here, that'd be great. Those numbers are populating huge here.
And yeah, we like to summarize this after the webinar too, and let everybody know what people thought. My guess is it'll either be the S&P 500 or NCREIF, or it could be NAREIT. Be surprised if it's farmland, timberland, or corporate bonds.
All right, we're going to close the polls, and let's share those results. Can everybody see the results there? Jeff, can you see the results?
I don't as an organizer, so you'll have to summarize it for us.
Okay, so it looks like we have 51% at NCREIF. Property returns, leveraged or unleveraged. Farmland or timberland, we're looking about 2%. S&P stocks is 16%, so pretty close on that. Corporate bonds is at 6%, and NAREIT index is at 25%.
Okay, that's pretty consistent with what the NCREIF members thought. So what have the returns looked like if we go back to fourth quarter 2015 up through the first quarter 2019? They are really pretty steady. I mean, we had the drop, from 2015 into 2016, but then really 2017, 2018. I don't have the longer term history on this graph, but we've never really had this long a period of time when returns really pretty much stayed at the same level. And you can see the slight uptick for the first quarter of 2019, which is a little bit of a surprise, but and we do have to be careful putting too much weight on one particular quarter. So I think in general, maybe the way to think of this is returns are holding steady for private real estate. I need to explain a little bit more on this one. There's actually several different types of funds that NCREIF members have, companies like Morgan Stanley and JP Morgan, they have open-end funds which people can come into and go out of anytime they want. So any particular quarter, they can add money to an open-end fund, or they could take their money out of an open-end fund. And this particular slide is the performance of just a subset of the open-end funds that are within the NCREIF index. We put a lot of attention on this within NCREIF because it's become a benchmark for the performance of funds. ODCE stands for Open-End Diversified Core Equity. So these are really large, well-diversified, low-risk funds. They have properties throughout the U.S. and all the different property types in the fund, so they try to be well-diversified. And these properties, because they're open-end and people are coming in and going out every quarter, they tend to have external appraisals every quarter, or if not an external appraisal, a good internal appraisal. A lot of times they're managed, their appraisal process is managed by a company like Altus or Real Estate Research Corporation. And so I emphasize that because notice the returns for this index were actually down this quarter. So we have a difference of opinion here. This is a subset of the properties that are in the overall NCREIF property index, which was up. So it's kind of like, well, did they really go up, or did they go down? And I'm going to drill into that a little bit more in some of the follow-up slides. But since I mentioned there are actually different types of funds from NCREIF members, just to go off on a little bit of a tangent, some of you may be interested. There's also closed-end funds. Those are funds where the manager will raise money for the fund up front, and then buy the properties. Then they'll raise the capital during the first year or two, but once you're in for the duration of the fund. These will typically have a 5, 6, 7 year life, and then they'll sell the properties and distribute the capital to the investors. Excuse me. So that would be a closed-end fund. And then there's also what's called separate accounts, which is a fund that's managed just for CalPERS. They might have a fund that's only properties that CalPERS wants you to invest in for them. So again, I mentioned that because there's a difference of opinion, it seems, here between what was thought to happen on properties that are in this open-end diversified core equity fund index and the overall NCREIF index, which includes these other fund types. So let's look at what really caused the difference here. Excuse me. So you see retail properties way up for this quarter compared to last quarter. Last quarter, the retail was actually down. Of course, we hear all about the store closings and all that going on. But on the other hand, and when I dug into this more, and we talked to the managers to find out what's going on, why all of a sudden are your retail properties up this quarter? And it turns out that in a lot of cases, especially properties in some of the separate accounts, they had an external appraisal done this quarter, and the appraiser was much more optimistic than the internal appraiser was last quarter. And these were a lot of these were malls that were $1 billion. I think one of them was even $3 billion mall, super regional mall. So I think part of the lesson here is, there's certainly malls out there, especially the well-located super regionals, that are doing quite well. And the appraisers and the investors are optimistic about the performance of those malls. They don't have stores that have closed, and they're doing quite well. So probably a difference in opinion on where retail is headed right now. Some retail doing very well, others hurting, and probably harder to value retail than it's typically been. If we look at, again, just those properties in the open and diversified core equity index, those returns for retail properties were down. But those are different malls, and so that doesn't necessarily mean one is right and one is wrong. Just we got some malls that are doing very well, other retail, not necessarily malls, could be freestanding that aren't doing quite as well. Industrial, you see that's way up for the first quarter for this index, and like I said, the overall for all of NCREIF was just still at really high levels, down just slightly, but within this index, actually, you can see up quite a bit, 3%. These are quarterly returns, so 3% per quarter, 12% per year, and these are unlevered. So you leverage that up, and you're talking about some pretty nice returns for warehouse properties. So again, a comparison of these two indices: apartments about the same for the two indices, industrial about the same, office about the same. It's really a difference in what's going on with retail properties. So from NCREIF members, had a lot of questions about that this quarter, as you can imagine. So let's look at a little bit longer term comparison of each property type on the same graph, and you can again see how industrial has just done really well, starting in back in about 2015, just really diverged from the other property types, which kind of trended down, but leveled off for the most part. Retail, you see the uptick in the overall index this quarter, and maybe retail just was oversold, maybe, if that's the term. Maybe it really has turned down, and we'll see it coming back up in line with those other property types. You can see apartment and office and retail all kind of about the same level of return for the last year or so. Looking at the components of return, so it's like, okay, what is giving us our return each quarter? Is it cash yield? Is it NOI growth? Is it cap rate changes? Or other effects, because things never quite add up. But you can see we had a lot of red up until recently, right? A lot of cap rate decreases, which were helping returns. We all know that the interest rates drop and cap rate compression. Can't rely on that anymore. If anything, if interest rates go up, could work against us if cap rates go up with interest rates. So it's really NOI growth that we're going to have to count on, and cash yield. So the combination of cash yield and NOI growth are going to be the key to keeping returns where they are, and hopefully those returns will keep continuing. So let's take a look at another question. What will be the annual return? Think of this as return for private real estate for 2019. Currently, we're at about 6.8% unlevered. Do you think we're going to drop below 4 or stay kind of in the range of well, actually 4 to 6 is a little bit lower, and then 6 to 8, which would be kind of capturing where we are right now, and if you're really optimistic, above 8.
All right, everyone, the polls are open right now. We have 25%, 27, 31%, 34. Everybody is on the gas with these polls right now. Fantastic. 51%. We're going to close them out here in about 30 seconds. I wish everybody could see what I'm seeing right now live and watching the numbers bounce around. It's exciting to see. All right, just a few more seconds and we're going to close the votes. All right, the votes are closed. And I'm going to share them here. So what will the annual NPI total return unleveraged be for 2019? And coming in at 10%, we are at below 4%. 4 to 5% is 25%. 5 to 6%, we're looking at 43%. And above 6%, we're looking at 22%.
All right. Let's look at cap rates in a little bit more detail. And again, no surprise, cap rates have been steadily declining since about 2010. Actually before that, but we all know that 2008 pushed them up for a while, but then declining after we started the recovery from the financial crisis. Note that we really have a close, high correlation between cap rates and BAA bonds. A lot of people like to compare cap rates with 90-day treasuries, but you can see from this graph, it's really that the BAAs that are probably the best indication of where cap rates are headed. Hard to say if that relationship will always hold true, but certainly for quite a few years now, a little bit of a divergence in 2008, but overall, cap rates kind of move in line with that yield for the BAAAs. This is another look at cap rates along with the discount rate. This is a little different graph. In this case, it's based on the appraisals that are being done on the properties. So the cap rate here actually comes from Altus that does valuations on a lot of the properties in the NCRE index, especially the open-end diversified core equity index properties. And so they provided data on what the cap rate is that's implied by their appraisals, along with the discount rate that they're using to discount the cash flow. So if you think of somebody doing like a 10-year discounted cash flow analysis in Argus, right now they would be using about a what do we got? Have 6.5% discount rate. So in other words, on an unleveraged basis, the assumption is that investors will buy based on getting a rate of return of about 6.5%, between 6 and 7% over the next 10 years. You can see that's been steadily declining over time, which of course is one of the reasons that the cap rate's been declining over time. Difference between the cap rate and the discount rate is your growth that you expect in property values. So if you're buying a property at a 4.5, let's say, cap rate, how do we get up to a 6.5% rate of return? Well, you'd have to have about 2% growth in income and value every year. This slide was actually added by the colleague that from Bentall Kennedy that did the NCRE webinar with me this quarter, and his point here was that interest rates in the U.S. Are really pretty high relative to other countries. Maybe Trump arguing, that the Fed should lower rates is right when you look at this. You can see compared to all these other countries listed here, interest rates in the U.S. are higher, even though our interest rates are low by historical standards. So maybe we won't see much of a rise in interest rates in the U.S. over the next year. We know the Fed started to raise them, but has kind of backed off, and even some talk they might have to lower them if these trade wars continue. So who knows? We'll just have to keep our eye on that. Cap rates by property type. I've mentioned this before during this webinar, but I keep being surprised that industrial is the highest of the cap rates when it's been performing the best. And I don't really see that industrial properties are riskier than the other property types. Of course, that gap has been narrowing. We see that here, but it's still the highest of the other property types, which makes me think industrial properties, warehouse properties have a ways to go in terms of keeping on performing well compared to the other property types. Apartments, the lowest cap rate. Those have historically had the lowest cap rate. A little bit of a time period there when office dropped lower, but in general, you usually see apartments lower. Part of that may be that they require less capex than the other property types. So where do we think cap rates are headed? Below 4, 4 to 5, kind of where they are now, 5 to 6, or above 6.
Polls are open, everyone, and we got 22% voted. 33. It's getting faster and faster and faster every poll that we launch. Look at that. 55, 58%, 60%. Let's see if we can get 100%.
Always people that are multitasking, right?
I try. I'm not that good at it. We're at 69% voted. We'll keep the votes open here for another 30 seconds, 71%.
This is probably one of the more important questions, right? That's going to determine where real estate is headed. If cap rates go up, that's going to put downward pressure on values, unless it's accompanied by inflation. In fact, I should say that differently. Inflation could help keep cap rates where they are, even if interest rates go up, because of that growth factor that we talked about before.
Let's share it right now. We looking at below 4% coming in at 5%. So below 4% is 5%. 4 to 5, we're looking at 44%. 5 to 6, we're looking at 41%. And then above 6% is 10%. So everybody is betting on 4 to 6%. Nothing really above, nothing really below that 4%.
Okay, that's just. I think we'd all be pretty happy if it kind of stayed in that range. This another way of looking at where values have been and where they're headed starts back in 1999. So you can see how that if we look at the red line is market values. How it dropped with the financial crisis, dropped significantly with the financial crisis in 2009, but way above the peak that we had before the financial crisis. And even though returns are down this quarter, we could say that the real estate market hit new highs because the price level did rise this quarter. NOI also has been rising. It wasn't really impacted as much by the recession because the lease is in place. So an index of NOI, we always still had positive NOI on the properties, even though it was down. So that gap between the red line and the green line, between the price index and the NOI index, is of course your drop in cap rates. So people were paying more and more for the same level of net operating income. And then we also see the cap rates, how they drop, the blue line there. So you can see the importance of cap rates in what people are willing to pay for the certain level of NOI. So hopefully if cap rates kind of stay in the same range they are and we continue to get some NOI growth, our values will at least hold steady. But big question, of course, is if we are going to hit a peak this year, is that red line going to finally stop rising? Not that we want it to, but people tend to think real estate and markets in general and the U.S. economy has to go through cycles, and this cycle has to end sometime. We'll see. And I think we have a question on that. But before we get to that, just to show you that the people wanting to put money in, contributions into these funds that we talked about, the open-end, in this case, that Odyssey Fund, Open-End Diversified Core Equity Fund, the contributions are right in line with distributions coming out of the fund. So we don't have a problem where more people are taking money out than money coming in. Things are pretty much in balance there, which is good. We do hear that there's some so-called dry powder for people to invest if they find the right opportunities. So when will that market value index peak? Do we think, and it could have peaked this quarter, or is it going to be next quarter, before the end of the year, or are we just going to keep on chugging along and keep reaching new highs? So it's going to be 2020 or even later.
All right, polls are open right now. We do have a short question here. How could we have a compressive cap rate while interest rates go higher? Short-term interest rate. Hopefully, I answered said that question right, Jeff. I'm not sure if it's in your brief.
So we saw that it's really the longer-term rate that has more of an impact on cap rates, those BAAAs. And that graph does tend to suggest as interest rates go up, it would push up cap rates. But we haven't had much inflation over the whole time period that graph was covering. And what we have to keep in mind is that the difference between a cap rate and a discount rate is, like we saw in that one chart, is your expected growth. And growth comes from inflation. That's part of the reason that property values rise is because of inflation. So if interest rates go up, let's say by 1%, but inflation goes up by 1%, that means property values should go up by 1% more than they would have otherwise. And so that tends to keep cap rates the same. Cap rate is like saying, let's take the discount rate, the rate of return investors want minus your growth rate. So the discount rate could go up by 1% with interest rates, but the growth rate goes up by 1%. So your cap rate stays the same. Most people that I talk to, and my view is probably that if interest rates go up by, say, 100 basis points, cap rates will probably go up, but not by 100 basis points. Maybe 25 basis points. So there'll be some pressure on cap rates to go up, but I don't think it'll go up with the full amount of any increase in interest rates. Hopefully that got to the question.
Fantastic, everybody. And the poll is closed, and I'm going to share the poll right now. So when will market values peak for this cycle? And we have peak this quarter is 9%. Next quarter is 16%. Before of end of 2019 is 38%, in 2020 or later. So it looks like good news for that poll right there, Jeff.
Oh, good. Let's hope they we just keep going. They, you hear more and more on shows like CNBC talking about the overall economy, that cycles don't necessarily end by old age. So hope that's true. Occupancy, you can see here, occupancy is really pretty much the same as it's been. Continues to be near record high levels. I don't know that occupancy can go much higher for apartments and industrial properties. You always have people that are moving, and what they call frictional vacancy. So we really are at relatively high occupancy levels. Hopefully occupancy, that's sort of the fundamentals of what we call the space market, as opposed to the capital market where we get our cap rates. The space market still looks pretty good. You see here the vacancy rate over time for the different property types, and see how office is the highest right now, but has been coming down, vacancy rate coming down a little bit on office properties. Industrial, you can see how that's really come down since 2000, say 2011, just dropped to where we just we're going to have new supply of warehouse space. Some coming online nationally, but not enough to drive those vacancy rates up yet. And then our NOI growth, for retail, not surprisingly, it's the lowest, but it's hanging in there. It's still staying positive. It's leveled off, actually, maybe up a little bit over the last couple quarters, which may be part of the reason that some people think, some people become more optimistic for the direction of retail. And then we have apartments up. We have the index overall up. We have office up, and industrial NOI growth staying at that relatively high level. Again, the fundamentals, are really driven by that NOI growth and the occupancy. And then this is digging a little bit more on rent growth just for this quarter compared to last quarter. You do have to be careful in any one quarter's data. So while it does show rent growth for the retail down a little bit this quarter, average that in with last quarter, still got a pretty decent level of rent growth for retail properties. We usually look at these things more on a rolling average basis, so wouldn't read too much into the NOI or rent growth being down for just the single quarter. But it's something we have to keep our eye on. Sometimes, when you do see one quarter reverse direction, it can become a red flag. 2 quarters, then we got to start to worry. Then just digging in a little bit more on the subtypes. We've got garden apartment doing the best in terms of returns compared to the high rise, which are at the other end of the spectrum. So there are certainly differences in performance within apartments. Same idea with office there. We tend to look at it in terms of CBD versus suburban, and the suburban office in recent years has been what's been doing the best. Hasn't always been true, as you can see from the graph, but more recently, suburban office is what's been doing well compared to the CBD office. And then for retail, we can see the regional malls jumped up here this quarter. then the other end of the spectrum, we have the let's see, I guess that's the total index. The of the retail properties, the neighborhood are doing the best. And then for warehouse, this has all the different industrial types that data is collected on, but really the majority of the properties are warehouse. There's some R&D flex in there, actually some light manufacturing. That data there is really pretty small, so it's really the warehouse properties that are driving the overall industrial index, and you can see that on the. It's hard to distinguish between the warehouse index at the top and the index for all industrial properties at the top, which are quite a bit above. You can see the overall NCRE property index that has all the property types combined. And I think this, well, I think we have two more questions. So this one, what will be the best performing property sector in 2019? Apartments, industrial, office, retail. See if anybody votes for anything besides industrial. You never know.
That was a pretty good guess because it's off to the races for industrial. Everybody's voting. We have 52% votes, and why the votes are coming through. We got another good question here. Historically, what impact, if any, does the election cycle have on cap rates?
Oh boy, I haven't looked at that. I'm not sure I can answer that one. That's a good question. I mean, the election of Trump, whether we like him or not, I think kept the economy from dropping. The combination of the tax cuts and less regulations, I think, is one of the reasons why we've had nice steady returns over the last year or so. Now, whether that just pushed off the recession until later, and whether these trade wars catch up to us, and whether that results in a change in who's in office next time, hard to say. But I guess I don't really have a good answer to that one.
We might have to have a follow-up,
huh? Interesting to go back and take a look at. Yeah.
So let's go ahead and share that poll here. What will be the best performing property sector in 2019? We are going to have apartments coming in at 17%. Hospitality is 0%. Industrial is at 75%. We have office at 6% and retail at 2%.
Okay. A little bit look at the kind of the top CBSAs where a lot of the at least the institutional capital is. You can see that San Francisco, Los Angeles, West Coast. Well, I imagine we have a lot of viewers today. Is doing the best compared to DC and Chicago, and those are kind of at the other end of the spectrum. New York. So we certainly do have some differences in the performance of the different CBSAs. It kind of varies over time, although I guess over this period of time it's been pretty consistent. And then also looking at a broader set of CBSAs, it's kind of a busy graph, but what you're seeing there is the length of the bar is the high to the low, so the range of returns over the last 15 years. So no surprise, areas like Riverside, dependent more on tech industry, have a much wider range of returns. And you also see the median, which is where the color changes. Not real obvious, but that's where the color changes. And then whether over the last quarter it's been headed up or headed down, and where it is now compared to the median. So you can see some are a little bit below the median, some are above the median. Actually, a surprising number are kind of at the median over the 15 years for return. And I think our last question here. So, what what keeps you up at night, or what would you think might have the biggest impact on commercial real estate? Is it going to be rising interest rates? Maybe that's off the table. Who knows? Um, Politics, getting pretty crazy there in Washington with all the fighting going on. Is it going to be inflation, or in the news a lot, of course, right now, the trade wars?
And the votes are flying in here. It's like a horse race, Jeff, on the other end here, watching these things go up and down, up and down. And looks like we have 50%. 55%. The votes are going to close here in about 30 more seconds. This one's neck and neck.
Wow. Between politics and trade protectionism?
And interest rates, believe it or not.
Oh.
Interest rates and politics are tied right now. So we're going to close the votes in here about 6 more seconds. Ooh. Interest rates just eked it out the last minute. Looks like we have federal interest rates, rising interest rates at 29%. So that's second on the list. We have politics coming in at 25%. That's going to be third on the list. Inflation's at 16%. And then trade is the highest at 30%. So the top two we're looking at is interest rates and trade, followed by political and then inflation.
Interesting. Certainly, like I said, trade in the news every day now, and causing a whole lot of volatility in the stock market, and that's going to impact real estate in ways that I don't even know if we know all the possible ramifications of it yet. All right, so summary. As we saw, the overall index reversed its downward trend, but that other index did continue down. So sort of a tale of two indices here, and we've got to keep our eye on both of them. The capital return, though, which is the price appreciation, was still positive, so we have another new high in market values. Cap rates dropped slightly, which helped to push returns and values up to a new high. Industrial is still the leader of the pack, and retail did benefit from several write-ups. We'll see if that continues. And occupancy, although just down slightly, is still near historic highs. And I didn't say it here, but NOI growth is still good. So overall, I think we can feel pretty good about the quarter. We didn't really have anything bad happen. If we keep going on at this pace, I think maybe we'll all be pretty happy. Maybe we'd like to see, higher returns and more increases in market value. But if we don't go into a recession, that's good. Matt, any parting comments or questions?
Yeah, we do have some additional ones here. Is the PowerPoint going to be available? That's definitely one question we get all the time, and I don't know how to answer that, Jeff.
Yes, we've been making it available. I'm not sure how it's posted, but Jeff posted it, and I think we send an email out to people that registered, letting them know it's been posted.
Fantastic. I'm sure we'll have the recording available for everyone as well. Again, everybody, if you have any more questions, we're happy to answer them. A lot of people are saying thanks. And then also in apartments, what class, A, B, C, is driving the cap rate compression?
That's a good question. We didn't separate that out. The NCRE properties are mostly what you'd consider Class A. We don't actually collect class on the properties. But I would say, since most of the properties in the index are more your Class A apartments, that we're really looking for the most part at Class A returns in this data.
Hopefully that answered your question there. Does anybody else have any additional questions here? Again, we're going to send information out of this recorded video, the slide deck. We're also going to share the polls with you. And maybe we'll even do a brief survey of what the market beat would be like, so we can get some more information from everybody and share it out. Great, thank you. Just fabulous questions that are coming in here and statements. It's always a pleasure to have Dr. Jeffrey Fisher a part of these presentations with us, as well as each and every one of you on this call. Without you, we wouldn't be here, and we appreciate everybody. Jeff, do you have any parting words before we head off for the rest of our Tuesday afternoon here?
See you next quarter.
Thanks, everybody. Have a great afternoon. Bye-bye.